When it comes to investing in the stock markets, there are numerous strategies you could adopt, actually, depending on your risk tolerance, risk appetite, depending on your time horizon, and your investment goals, your investment plans, actually. So, in this video, I want to talk about a particular strategy known as position trading. It is called position trading. This particular strategy is more of an investment technique, an investment strategy than a trading strategy. It's adopted by long term investors. So how do you implement position trading? To successfully implement this particular strategy, you need to know the following factor. I want to really take time to explain in this video. Please subscribe to this channel if not done that. And don't forget to like this video and also drop a comment in the comment section so as to be able to clarify things wherever and whenever necessary. Number one is fundamental analysis. When it comes to position trading, you need to take into consideration what is called fundamental analysis. So in this case, you focus on companies with strong financial health, solid earnings potentials, as well as low debt with favorable industry conditions. Look at the company's balance sheet. It must have a fortress balance sheet with low, short-term debts, as well as it should be in a sector that is actually benefiting from the overall economy. So you look at key metrics like the earning per share, as well as revenue growth, and also you consider debt to equity ratio. That is the volume of debts the company is owing compared to its equity. So these are the fundamentals you need to take into consideration. And so once these factors are fully in place and are favorable, that should be a good candidate for position trading. That particular stock is a good candidate, for you to employ this particular trading or this investment strategy. Number two is use technical analysis for timing. In as much as you depend solidly on fundamental analysis, as I've just explained, you don't, neglect technical analysis. So in this case, you employ factors like trend indicators. So you use what is called moving averages. It could be 50-day or 200-day moving averages to identify, a trend direction, the direction of the trend, because as we all know, the trend is your friend. You don't go against the trend. You move alongside the trend. Not only that, you try to identify breakout and support. So you enter positions at what is called the breakout points, or when an asset bounces off, key support level. In a typical stock graph, the graph doesn't really, it isn't a straight line graph. It goes this way, kind of, up and down, as it maintains a particular trend. So try to identify, both the breakouts and the support level, and I will then give an idea on where to place your order, on where to buy your stock for maximum returns. Number three is clear entry and exit strategy. You must have a clear entry and also a pre-planned, exit strategy. So in this particular context, you should have a price target. So you set a reasonable target prices based on fundamental analysis. Where do you want to buy the stock? At what price do you want to buy, the stock concern? You also have what is called, a stop loss order. This will protect your investments, against unnecessary losses. All right, that will then go a long way in limiting your losses. So a stop loss actually has to do with choosing a particular price points. You wouldn't want your investment to go below that price. Let's say maybe $5. So if you place your stop loss at $5, by the time your investment falls to around that particular price, then the system will automatically sell off your position so as not to sustain, losses or further losses as the case may be. So you could equally adopt what is called, a trailing stop. It lock in profit without trailing stop as the asset prices rises. You could this particular strategy is used to lock in your profit. As the asset price rises, you can harvest your profits without losing them in the process, in case the market, undertake a downturn. So number 4 is patience and discipline. Patience and discipline. So position trading requires a long-term focus, a long-term horizon. Have a long-term mentality. So avoid reacting to short-term volatility or fluctuation in the market. You stick to your investment thesis, unless the fundamental of the company changes. If the story remains the same, then you maintain your investment. Except there's a change in narrative along the line, then you could consider, selling off a position or whatsoever. But the point is just that as long as the narrative remains the same, the fundamentals are still okay, are still positive, you are expected to maintain your position. You remain patient. You don't allow short-term fluctuation, short-term noise in the market to determine your reaction as an investor. You remain immune to emotions in the market. Number 5 is periodic monitoring and rebalancing. Periodic monitoring and rebalancing. Actually, you need to regularly review your positions to ensure the market conditions or fundamentals, have not changed. As long as the fundamentals, that's the reason, on which you bought the company are still the same. If the reason remain unchanged, then you are expected to keep on holding your position. But if the reasons actually, get altered, then of course you think about, rebalancing your portfolio, as the case may be. So you need to, review your portfolio, you rebalance as necessary, so as to be able to maintain, your investment in the right course. Number 6 is risk management. Risk management, when it comes to investing, is full of risk. Stock market investing is inherently risky, as you must put in place, a risk management measure. One of these measures is diversification. So when it comes to diversification, you spread risk across different sectors, in the markets, different sectors, different industry, you spread your risk, you spread your bets, you spread your, your stock picks across different sectors in the markets. Not only that, what you call position sizing, you also adopt position sizing. You avoid concentrating too much capital in a single trade. No. Instead of placing, maybe let's say you have let's say ₦1,000,000. Instead of placing ₦1,000,000, in a single or two stocks, you can spread it across maybe 5 or even 10 stocks. You could put in ₦200,000 for 5 into 5 stocks, or 100,000 naira, in 10 stocks. So you adequately do what? You size your position, adequately, so as to be able to reduce risk. And then you consider risk reward ratio. All right. So you aim for trades with, at least 2:1 risk, to reward ratio. In other words, your downside position should be less, minimal compared to your upside position. All right. So you take into consideration, your risk reward ratio, and 2:1 is a very, very good, ratio. Number Number seven is adapt to market conditions. You adapt to market conditions. So in this case, you stay away, you stay away from macroeconomic, events and adjust your strategy based on market cycles, such as shifting from growth to defensive stocks, as the economy determines. So don't just invest and go to sleep. No, you monitor the macroeconomic environment. All right. If it becomes necessary, you can shift your position from growth stocks, which are normally risky, into defensive stocks, which are less risky. You could shift your position from value stocks, into growth stocks, as the case may be. You could shift your position from momentum stocks into dividend paying stocks. It all depends on the macroeconomic indicators. Number 8 is avoid over trading. Don't trade too much. Don't churn your portfolio too much. Stick to your plan and avoid making trade based on short-term fluctuations. Focus on the long term. Don't just keep on buying and selling, selling and buying. No. You buy sparingly and you hold on to your position so as to be able to benefit from the normal compounding that comes with time. And not only that, number 9, you leverage compound growth. In this case, you may employ dividend reinvestment strategy. As your dividend comes in, what do? You reinvest it. Don't just spend your dividend. You reinvest your dividends to do what? To keep on earning at a compounded rate. Not only that, you also focus on long-term and long-term gains. You invest for the long term, because the longer the time horizon, the more your investment compounds. You allow your investment to compound, and the more investment compounds, the more money you make at the end of the day. Someone said that compound interest is the 8th wonder of the world, and I think the individual is correct. So the more you allow your investment to mature, all things being equal, the better the returns you are going to get. And then number 10, lastly, you stay educated, remain educated. Be consistent with your knowledge acquisition. And so keep up with industry news, market trends, and economic reports. Learn from past threats or past mistakes, as the case may be, to refine your strategy over time. And so when it comes to investing, you need to remain educated. That's why this particular channel is here for you. I bring out videos that are channeled towards making you a better informed investor. All right. So thank you very much for watching.